Today, we're going to jump into an analyst's deep dive of a company that really owns the bones of our economy, Brookfield Infrastructure. We're going to unpack their business, weigh the good against the bad, and figure out what it's actually worth. So let's get right into it.
And this really gets to the heart of the whole thing, doesn't it? On one side, you've got these incredibly stable, almost predictable cash flows from assets we all need. But on the other side, there's a balance sheet with a lot of debt. So which is it? Is this thing a fortress of cash, or is it a ticking time bomb? Let's find out.
Okay, first things first. Before we can even touch the numbers, we have to understand the business itself. I mean, what does Brookfield Infrastructure actually own that generates all this money?
We're talking about things that are absolutely essential to our modern world. Think about it. Utilities, toll roads, massive shipping ports, pipelines, even data networks. These are assets with huge barriers to entry. You can't just wake up tomorrow and decide to build a competing port. Their income is often regulated or locked in with long-term contracts, which makes it incredibly steady, even when the economy gets a little rocky. And this right here, this is their secret sauce. Brookfield doesn't just buy stuff and hold on to it forever. No, they are masters of what's called capital recycling. They hunt for undervalued assets, buy them, make them run better, collect all that stable cash flow, and then, once the asset is mature, they sell it for a profit. Then they take that money and do it all over again. It's a really powerful engine for growth.
All right, now for the fun part. Let's get into the numbers. This is where we really see that central conflict, that tension for anyone looking at this company.
And this slide just perfectly lays out that battle. In one corner, you have the engine of the whole operation, that strong, consistent cash flow. But in the other corner, you've got the fuel it's running on, a serious amount of debt. The entire investment case really hangs on one question. Is that cash flow strong enough to handle the debt with plenty left over for investors?
So let's put a number on that debt. We're talking 13.29 billion Canadian dollars. That is a huge figure, and frankly, it's the number one reason some investors get a little nervous. It's more than double their entire market cap.
But, and this is a huge but, look at the other side of the coin. The company churns out $759 million in free cash flow every year. That's the cash that's left over after all the bills are paid. It's the money they can use to pay down that debt, invest in new stuff, and, of course, pay shareholders.
Okay, this slide is so important because this is where a lot of people can get tripped up if they're not careful. You'll see this amazing operating margin, over 60%, but then you'll see that the company actually has negative net income. How is that even possible? Well, for a company like this with massive assets, depreciation and financing costs are huge expenses on paper that can totally wipe out your accounting profit. That's why savvy analysts pretty much ignore net income and focus squarely on the cash flow. That's the real measure of health here.
So we've got a handle on the business, we've seen the financials. Now, what about the bigger picture? What are the major risks and opportunities we need to be watching? Using a weighted SWOT analysis, which is just a fancy way of giving more importance to certain factors, we can see how things stack up. The strengths and opportunities come out on top. With a total score of 6.85, it looks like on balance, the good stuff seems to outweigh the bad.
But we absolutely cannot ignore the risks. The analysis points out four big ones. First, rising interest rates. That's a huge deal because it makes their massive debt pile more expensive to service. Second, regulatory changes could mess with their profits. Third, that high leverage can really amplify any economic downturn. And finally, let's be honest, this is a complicated company, which can sometimes make it hard to see what it's truly worth.
And this brings us to the million-dollar question for any investor, right? After all that, what is a fair price to pay for this business? Let's see what the analyst's valuation says. So by blending a couple of standard valuation methods, the analyst gets to an intrinsic value of about $60 a share. At the time of the analysis, the stock was trading around 56 bucks. So yeah, it looks a little undervalued, but, and this is key, there's not a huge margin of safety. We're only talking about a 7% discount.
Now, a good analysis never just gives you one number. It's all about the range of possibilities. In a worst case or bear case scenario, maybe the value is closer to $48. But if everything goes right, in a bull case, it could be as high as $75. That base case of $60 sits right there in the middle.
And this is where the analysis gets super practical. Let's say your personal goal is to make a 9% return every year. Well, this table shows you the price you'd need to buy in at to make that happen. So to hit that target over the next, say, 7 to 10 years, you probably want to buy in below $50 a share.
So after breaking down the business, crunching the numbers, weighing the risks, and running the valuation,
Where does the analyst finally land? What's the call?
The verdict is pretty clear. It's not a screaming buy at its current price. It's a hold. But if the price were to dip below 50 Canadian dollars, that small margin of safety would get a lot wider, and that's when it would start to look like a really attractive buy for a long-term investor shooting for that 9% return.
Okay, let's sum it all up. Here are the main things you should take away. 1. Brookfield is a very high-quality company with a fantastic business model and durable cash flows. 2. The price right now is just kind of fair. The valuation is only moderately attractive. And 3, that high leverage is the big one. It's a real risk you have to be comfortable with. The whole story here is a balancing act between quality and price.
And that's our look at an analyst's journey with Brookfield Infrastructure, a fascinating story of quality, debt, and value. But now I want to hear from you. What company should we put under the microscope next? Let us know your picks in the comments below.